Federal Reserve just fundamentally changed the timeline, your strategy, and what you should expect from mortgage rates over the next 18 months and most. Homebuyers have absolutely no idea this happened because they were not paying attention to what Jerome Powell actually said in December 2024. Here is what you need to understand right now. The Federal Reserve cut rates in December, which sounds like good news, but simultaneously signaled that future rate cuts in 2025 and into 2026 will be significantly slower than the market was expecting, which means mortgage rates are likely to stay elevated around 6% or higher for much longer than most people anticipated. And that completely reshapes whether you should buy now, wait until 2026, or potentially miss the window entirely. So in this video, we're breaking down exactly what the Fed announced, what their 2026 projections actually mean in plain English, how this translates to real mortgage rates and housing affordability, what the housing market will look like throughout 2025 and into 2026, and most critically, what you should actually do right now if you're a prospective homebuyer trying to time this market correctly. Let's start with what actually happened in December 2024 because this is where everything changed. The Federal Open Market Committee, the group within the Federal Reserve that sets interest rate policy, cut the federal funds rate by 25 basis points in December, bringing the target range down to 4.25 to 4.5%. That was the third rate cut in late 2024, following cuts in September and November. On the surface, rate cuts sound positive for homebuyers because the federal funds rate influences all borrowing costs in the economy, including mortgage rates. When the Fed lowers rates, mortgage rates typically follow, making homeownership more affordable. But here's what changed everything: the language the Fed used in their December statement and the economic projections they released alongside. It revealed a fundamentally different outlook for 2025 and 2026 than what markets had been pricing in. The Fed introduced new language about the extent and timing of additional rate cuts, which is central banks speak for "we're slowing down, don't expect aggressive easing." The summary of economic projections that came out with the December meeting showed that the median FOMC participant now expects the federal funds rate to end 2025 at 3.9%, up from the 3.4% projection they had given just 3 months earlier. That's a half percentage point difference, which is massive in Fed policy terms. What this means in practical terms is that the Fed plans to cut rates more slowly in 2025 than they previously indicated, which extends the timeline before we see meaningfully lower mortgage rates. Now, why did the Fed change course? 3 main reasons emerged from Powell's press conference and the economic projections. First, the economy has proven more resilient than the Fed expected. GDP growth projections for 2025 were revised upward. The labor market remains relatively strong with unemployment still low. Consumer spending has held up despite higher interest rates. This economic strength means the Fed doesn't feel urgent pressure to cut rates aggressively to support growth. Second, inflation has been stickier than the Fed hoped. Core inflation, which excludes volatile food and energy prices, has been declining but not as quickly as the Fed wants. The Fed's December projections showed they expect inflation to remain above their 2% target through 2025 and potentially into 2026. As long as inflation stays elevated, the Fed can't cut rates too quickly without risking reigniting inflationary pressures. Third, the Fed is now operating in what Powell called a data-dependent mode where they make decisions, meeting by meeting based on incoming economic data rather than committing to a preset path of rate cuts. This flexibility allows them to respond to changing conditions but also means there's less certainty about the pace of future cuts. So what does this actually mean for mortgage rates? Here is the critical connection homebuyers need to understand. The federal funds rate and mortgage rates are related but not directly linked. The federal funds rate is the overnight lending rate between banks. Mortgage rates are based primarily on the 10-year Treasury yield, which is influenced by Fed policy but also by inflation expectations, economic growth expectations, and global bond market dynamics. When the Fed signals slower rate cuts and a stronger economy with persistent inflation, the 10-year Treasury yield tends to stay elevated or even rise because bond investors demand higher yields to compensate for inflation risk and opportunity cost. This is exactly what happened after the December Fed meeting. The 10-year Treasury yield initially rose as markets absorbed the implications of fewer rate cuts. The result for mortgage rates is that they are likely to remain in the 6% to 6.5% range throughout much of 2025 and potentially into early 2026. Some mortgage market analysts are projecting that the average 30-year fixed mortgage rate will hover around 6.1 to 6.3% through the first half of 2025, with potential modest declines to the 5.8 to 6.0% range in the second half of 2025 if inflation continues to moderate. But the key point is this: we're not going back to 3% or 4% mortgage rates anytime in the foreseeable future. The era of ultra-low mortgage rates that we saw from 2020 to 2021 was an anomaly driven by pandemic-era emergency Fed policy. The new normal for mortgage rates is likely in the 5.5 to 6.5% range, and that's what homebuyers need to plan around. Now let's talk about what this means for housing affordability and the actual housing market in 2025 and 2026. Mortgage rates around 6% create a specific affordability dynamic. On a $400,000 home with 20% down, you're borrowing $320,000. At a 6% mortgage rate, your monthly principal and interest payment is approximately $1,919. At a 5% rate, it would be $1,717. At 7%, it would be $2,130. So that 1 percentage point difference in mortgage rate translates to roughly $200 per month in payment difference, which is $2,400 annually, or nearly $73,000 over the life of a 30-year mortgage. For many homebuyers, that difference determines whether they can qualify for the loan or whether the monthly payment fits their budget. The Fed's slower rate-cutting path means homebuyers should expect mortgage rates to remain in the higher end of that range, which keeps affordability challenging. But here's where it gets interesting. Housing affordability isn't just about mortgage rates, it's also about home prices. And home prices in 2025 are expected to appreciate much more slowly than they did in previous years. The National Association of Realtors, Zillow, and other major forecasters are projecting home price appreciation in 2025 to be in the 2 to 3% range nationally, down from the 4 to 6% appreciation seen in 2024 and way down from the double-digit appreciation of 2021 to 2022. Slower home price growth helps affordability because it means the base price you're paying isn't escalating as quickly. If you're a buyer looking at a $400,000 home today, in 6 months it might be $405,000, $410,000, instead of $420,000, $430,000, like it would have been during the hot market years. The combination of stable to slightly lower mortgage rates and slower price appreciation creates what some analysts are calling a normalization of the housing market after years of extreme volatility. This normalization has specific implications. First, inventory is improving. Housing inventory, the number of homes available for sale, has been increasing throughout 2024 and is expected to continue increasing in 2025. We're now at the highest inventory levels since before the pandemic. More inventory means buyers have more choices, less competition, fewer bidding wars, and more negotiating power. This is a significant shift from the seller's market that dominated 2020 to 2023. Second, the market is becoming more balanced between buyers and sellers. Neither side has overwhelming leverage. Sellers can't demand massive over-asking offers anymore because inventory is higher and buyer demand is moderate. Buyers can't lowball because sellers aren't desperate and home prices aren't falling. This balanced market dynamic is actually healthier for long-term market stability. Third, days on market are increasing. Homes are sitting on the market longer before selling. The median days on market has increased from 15 to 20 days during the peak seller West market to 30 to 40 days in many markets now. This gives buyers more time to make decisions, conduct thorough inspections, and negotiate terms without feeling rushed. Now, here's the critical strategic question for homebuyers. Given what the Fed has signaled about 2025 to 2026 interest rate policy, should you buy now or wait? This is the question I get more than any other, and the honest answer is, it depends on your specific situation. But here's the framework for thinking about it. If you're financially ready to buy, meaning you have stable income, adequate savings for down payment and closing costs, good credit, and you found a home in a location where you plan to stay for at least 5 to 7 years, then waiting for perfect mortgage rate conditions could actually cost you more than buying now. Here is why. Even if mortgage rates decline from 6.3% to 5.8% over the next 12 months, Home prices will likely appreciate 2 to 3% during that same period. So the home you're looking at for $400,000 today might be $408,000, $412,000 next year. Let's do the math. Buying today at $400,000 with a 6.3% mortgage rate means borrowing $320,000, assuming 20% down, with a monthly payment of approximately $1,985. Waiting a year and buying at $410,000 with a 5.8% rate means borrowing $328,000 with a monthly payment of approximately $1,928. You saved $57 per month, but you paid $10,000 more for the home. Over 30 years, the payment savings total about $20,500, but you paid $10,000 more upfront, so your net savings is only about $10,500 over 3 decades. And this assumes rates actually drop to 5.8%, which isn't guaranteed given the Fed's cautious stance. If rates stay at 6% or higher, you've simply paid more for the home with no payment benefit. Additionally, waiting means you continuing to pay rent or staying in your current housing situation instead of building equity. If you're paying $2,000 per month in rent, that's $24,000 per year that builds zero equity. If you buy and your home appreciates even 2% annually on a $400,000 purchase, that's $8,000 in equity gain plus whatever principal you've paid down on your mortgage. Over time, that compounds significantly. So the financial case for waiting is actually weaker than many people think unless you have specific reasons to believe rates will drop substantially or home prices will decline, neither of which the Fed's current guidance supports. On the other hand, if you're not financially ready, if you don't have adequate savings, if your income is unstable, if you're not sure where you want to live long-term, or if you're stretching your budget to make the purchase work, then waiting makes sense regardless of what the Fed does. Buying a home you can't afford at any interest rate is a recipe for financial stress. The market will always have homes available, and there's no rush worth jeopardizing your financial stability. Now let's talk about what happens in 2026, specifically, because that's the time frame in the video title, and it's what a lot of buyers are asking about. Based on the Fed's December 2024 projections and the current economic trajectory, here's what 2026 could look like for housing. The Fed's median projection for the federal funds rate at the end of 2025 is 3.9%. If the Fed does cut rates further in 2026, mortgage rates could potentially drift down to the 5.5 to 5.8% range by late 2026 or early 2027. That would represent a meaningful improvement in affordability compared to today's 6 to 6.5% rates. A $320,000 mortgage at 5.5% has a monthly payment of about $1,817, compared to $1,985 at 6.3%, a savings of about $168 per month or roughly $2,000 per year. For some buyers, that difference could make homeownership accessible. However, here's the critical point. By 2026, home prices will have appreciated further. If homes appreciate 2% in 2025 and another 2% in 2026, that $400,000 home today is a $416,000 home in 2 years. You're borrowing more even if rates are slightly lower. The math might work out similarly to buying today. Additionally, if the market senses that mortgage rates are dropping and affordability is improving, buyer demand increases, which could accelerate home price appreciation and potentially offset the benefit of lower rates. This is the paradox of timing the housing market. The conditions that make buying attractive, lower rates, improving affordability, also attract more buyers, which drives prices higher. So what should homebuyers actually do right now with this information? Here's the practical action plan. First, if you're seriously considering buying in 2025, get pre-approved for a mortgage now. Lock in your financial picture, understand exactly what you can afford at current rates, and start shopping. Don't wait for perfect conditions that may never materialize. Second, focus on the fundamentals. Buy in a location you want to live long-term. Buy a home you can comfortably afford at current rates with room in your budget for unexpected expenses. And plan to stay in the home at least 5 to 7 years to ride out any short-term market fluctuations. Third, if rates do drop in 2026 or beyond, you can always refinance. Refinancing allows you to take advantage of lower rates without having to wait to buy. Yes, refinancing has costs, But if rates drop by 0.75 to 1.0 percentage points, the savings typically justify the refinancing costs within 2 to 3 years. Fourth, don't try to time the market perfectly. Real estate is a long-term wealth-building tool, not a short-term trading vehicle. Trying to buy at the absolute perfect moment is nearly impossible and often results in paralysis where you never buy at all. Fifth, pay attention to what the Fed actually says and does. Fed meetings happen 8 times per year. Each meeting includes a policy statement, economic projections, and a press conference from Powell. These are publicly available and provide real insight into where policy is heading. Don't rely on sensationalized headlines, go to the source. Now let's address the bigger question. What happens if the Fed's plan changes? The Fed's projections are not guarantees. They read based on the Fed's current assessment of economic conditions and their best judgment about how the economy will evolve. If inflation spikes unexpectedly, the Fed could pause rate cuts or even raise rates again. If the economy weakens significantly or unemployment rises, the Fed could cut rates more aggressively than currently projected. If there's a financial crisis or major geopolitical event, all bets are off. This is why Powell emphasizes that policy is data-dependent and decisions will be made meeting by meeting. The Fed retains flexibility to adjust course. For homebuyers, this means maintaining flexibility as well. Don't make financial decisions based solely on Fed projections. Make decisions based on your personal financial situation, your housing needs, and your long-term plans. The Fed's policy should inform your thinking about timing and affordability, but it shouldn't be the sole determining factor. Here's what we know for certain. The Fed's December 2024 update and their 2025 to 2026 projections indicate a slower pace of rate cuts, which means mortgage rates will likely remain elevated in the 6% range through much of 2025 and potentially into early 2026, before potentially declining to the mid to 5% range if conditions allow. Home prices are expected to appreciate modestly, inventory is improving, and the market is normalizing toward a more balanced state. For homebuyers, this environment favors those who are financially prepared, have done their research, and are ready to move when they find the right property rather than those waiting for perfect conditions that may not arrive. The bottom line is this: the Fed's 2026 plan has indeed changed expectations, but it hasn't changed the fundamental calculus of home buying. If you're financially ready, buying at 6% rates in a market with improving inventory and moderate price growth is still a viable path to homeownership and wealth building. If you're not ready, no interest rate environment will make a bad financial decision into a good one. Focus on your fundamentals, understand the Fed's likely path, and make decisions based on your situation, not fear of missing out or hope for perfect timing. If you found this breakdown helpful, subscribe because we break down economic policy, housing market dynamics, and financial decisions with real data and context. No hype, no speculation, just what the numbers actually show and what it means for your decisions. Thanks for watching, and we'll see you in the next one.